So guys, this is it. We've finally defeated COVID. Not really. Hi guys, welcome back to the channel. Today, I'm gonna quickly discuss what's going on in the stock market right now. As of a couple of weeks ago, the S&P 500 hit all-time highs, completely erasing the impact of COVID-19. And as of August 29, 2020, the S&P 500 hit 3,500 points, which is about 120 points over previous all-time highs from before COVID even happened. So before I tackle today's topic, let me give you guys a quick rundown of what the S&P 500 is and why everyone talks about it, why it's in every headline, and why every news publication talks about it on a daily basis. So what it is essentially the top 500 companies in the United States by size, meaning how much, the company's worth. That's what it is. They're kind of put into a basket. And obviously they have to be publicly traded, meaning being traded in the stock market. And why this is important is people kind of use this kind of basket as a way to gauge how the overall market's doing. So if the market's up, or if the S&P's up, the market's doing good. If the S&P is down, the market's doing bad. That's a very, very, very reduced and summarized version of talking of the S&P. If you guys want me to go into more in depth about the S&P, the NASDAQ, the Dow Jones, and talk about what they are made up of, leave it in the comments below. But anyways, getting that out of the way, let's dive into today's topic. So the S&P 500 hit an all-time high. What does that mean? Does it mean COVID-19 is a thing of the past and we don't need to worry about it anymore and we can start buying stocks left, right, and center? Does it mean the economy is fully recovered and we can expect people to be going back to work tomorrow? Or does it mean we've just started to scratch the surface on the impact of COVID-19 and what it can potentially do to our economy and the stock market? Let's find out. Just for a little history, in February of 2020, markets were doing great. I personally don't think the markets were doing good from a fundamental point of view, but that's a different video and I'll leave that for another video. Just for the sake of this video, the markets were doing good in February. We were hitting all-time highs, unemployment levels were really low, and everyone was spending like there's no tomorrow. Then COVID hit. From highs in February to the lowest low in March, the markets dropped about 30%, which was the most steep drop in the S&P 500 in all of history. You guys might say, oh, in the 01 dot-com bubble and in the 08, 09 mortgage crisis, the markets dropped even more, which is true. But what I like to point out is the trajectory of the drop from the COVID impact. During the dot-com bubble, the markets dropped the S&P rather, dropped about 49% in 30 months. During the 08-09 crisis, the markets dropped about 56. I keep saying markets. I mean the S&P. S&P dropped about 56% in about 17 months. For COVID, the markets dropped 30% in about a month. So that trajectory is bar none the steepest we've ever seen. And this is a really important fact that you guys need to keep in mind. So what does this mean? Well, this begs the question, how is this recession, depression, whatever we call it, different from 01 and 08? For the sake of this video, I'm not going to be comparing it to 1929, 1949, 1962, just because the video will be 2 hours long, and also because a lot of people who are watching this video are not going to be that familiar with those crises. So I'll compare it to something that most people can relate to and most people know about. If you guys want me to make an in-depth video about previous recessions and depressions, how they happened, who was at fault, how they recovered, leave it in the comments below, and I'll definitely get to doing that. So back to the topic. The fundamental difference between the crisis in 01, the crisis in 08, and the current crisis we're having is the ones in 01 and 08 were issues with the financial institutions themselves. What do I mean by that? So the crisis in 01 was caused by people injecting money into tech stocks, thinking they were the next big thing, and tech stocks realizing this and utilizing this invested capital to market their companies to make them seem more attractive for more investment instead of actually developing products. And when companies, or investors rather, realize that these companies weren't actually making the money that they said they were going to be making, and they weren't growing at levels that they said they were going to be growing, they got freaked out, pulled out their money, and the whole bubble popped. In 08-09, a lot of people who couldn't really afford mortgages were given mortgages or approved on mortgages, subprime mortgages. That in turn caused more houses to be sold to people who couldn't, again, really afford them. And this kind of artificially inflated the prices of homes, and this in change caused rates to increase, mortgage rates, interest rates, whatnot. And this caused people with these subprime mortgages with variable rates who could barely afford it in the first place to not being able to afford it at all, and forcing them to default. And this caused a ripple effect, and finally bit the institutions who lent this money out in the butt, causing the whole crisis. Finally, to talk about 2020. How they're different from 2020 is the 2020 crisis wasn't caused by companies being hyperinflated in terms of their valuation, or it wasn't really caused by inflated valuations or inflated real estate prices. This one was caused by a fundamental threat and scare to humanity itself. People don't know how severe COVID-19 was going to be, how it was going to impact society, how many people were going to die, how long it was going to be around, how long society was going to be in a standstill, when we were going to go back to normal, if we're going to go back to normal. So all these uncertainties caused people to do what people do: panic. People started pulling money out of their investments. So whether it be the average Joe like you and me, or institutions alike, they all pulled money out. The thing is, what caused this kind of steep pullback is everyone pulled money out at the same time, even more, I guess, aggressively than people did before, simply because everyone thought it was the apocalypse. People thought the world was going to end. And again, looking at 01 and 08, the impact of COVID-19 was more gradual, and also the sectors that got hit were a little bit more centralized. Again, most sectors did take a hit, but in 01, for example, you saw bigger hits in the tech sector, and in 08, you saw companies revolving around real estate, loans, whatnot. These companies were the ones that took big hits, big financial institutions giving out loans, giving out mortgage-backed securities, insurances for these mortgage-backed securities. So these are the type of companies that got impacted. But in 2020, everything got impacted. Everyone pulled money out pretty much at the same time out of everything, and that's why you saw such a steep decline. So now that we've kind of tackled how this pullback in the market is different from previous recessions and depressions, let's kind of assess and kind of look at how this market bounced back, and if it's a sign of recovery or if it's just another inflated market like previous times. One of the most obvious reasons for this bounce back in the market was the intervention of the Fed, or the Federal Reserve. In a previous video I talked about the Federal Reserve and how their policies kind of can have a really big impact on the market, and they could definitely move markets. That's where the saying "don't fight the Fed" comes from. So that was one of the biggest reasonings for this bounce back. The Fed intervened with various tools. One of these being quantitative easing. I'll put a definition to that up here, but essentially what it was is they printed money and used that printed money to buy securities on the open market, to inject money into the overall market. If you guys want me to make a video on quantitative easing and how it works, let me know. And I'm actually planning on making that video, so hit a couple likes on this video for me to make that next video, even though I'm gonna make it. Not only did the Fed take matters into their own hand and inject ridiculous amount of money into the market, even more than they did during the 08-09 crisis. They took it upon themselves to reinsure the economy, or the citizens rather, that they'll do everything in their power to continue to help the markets. So that reassurance is one of the biggest factors that played in this bounce back. Fed Chairman Jerome Powell, I love him. I love him. Said time and time again that he will do everything in their power and that the Fed has unlimited firepower to help the markets. So with that kind of words, reassuring words coming out, obviously markets are going to react positively. Another reason for this bounce back is the influx of retail investors coming into the market. What do I mean by that? What is a retail investor? Basically, anyone like you or me. Not a bank, not an institution, just the average Joe trying to make a couple extra bucks for their retirement, to buy their next home, to buy a car, whatnot. That's a retail investor. And if you saw during COVID, there was an influx of these type of investors who came into the market. Why is that? Simply because they had nothing better to do. A lot of them didn't have a job because they lost it. A lot of them didn't have anything better to do. No sports. They couldn't go out. So what better thing to do is than to throw some money, maybe their stimulus checks, into the stock market and see what happens. Maybe they can make a couple extra bucks. Who knows? So we saw a lot of that, and this could be reaffirmed with the hyper increase in the valuations or the stock prices of a lot of FANG stocks. You saw Tesla get over $2,000. You saw Amazon go over $3,500. So you could see that these are not institutions investing in these companies. These are average Joes buying stocks that are essentially buying headline stocks that are always in the headline, stocks that are very, very enticing to people who don't really know much about investing and assessing the fundamentals of a company, but rather they just invest on their gut, essentially. And also you could see that these hyper increases in the valuation of these FANG stocks really had an impact on the S&P as well, because they make up a large portion of the S&P. I'll put up a graph somewhere here showing you guys the makeup of the S&P 500. So their influence is substantial in the S&P. So when one of those stocks makes a big move up or down, it makes a big move on the S&P as well. So now, have we finally weathered the storm of COVID-19? Is the economy back to normal? Has it completely recovered from COVID? The short answer is no, it has not. First of all, everyone needs to understand that the stock market does not represent the economy. You cannot gauge the stock market and use that as a barometer or a proxy to assess the economy. They're two completely different things. Sure, the stock market is a part of the economy. We need to understand that in the stock market, even if every company is not making any money and quarter after quarter they're losing money, their stock price can still go up. It all depends on investors' view of the company. So sure, Tesla didn't make money for years, but people thought Tesla, or still do think Tesla is going to be the #1 name in electric cars when everyone adopts it. So that's why the stock is $2,500. Not because they're making money making so much money every quarter, but because people think their growth prospects in the future are ridiculous. The economy, on the other hand, is affected by various other variables. So whether how much a company or a country is exporting, how much it's importing, how much its citizens are spending. These are completely, different variables that can't really be assessed by looking at the stock market. So I feel like a lot of people have the misinterpretation that they think, oh, the stock market hit an all-time high, the economy is doing great. If you guys are looking at job numbers every week, if you look at job numbers, meaning how many people are filing for unemployment, it's still going up. We aren't seeing significant reduction in these numbers, so there's still people with no jobs. The US GDP contracted, meaning it was reduced by 32% in the last quarter. This is important. Why? Because now more than ever, the government's spending a ridiculous amount of money, whether the Fed pumping money into the market, inflating their, spending, and also all the stimulus bills that were passed till now, which are unprecedented. We've never passed this level of stimulus bills. So if the government rather continues to help out the economy with all these stimuluses, Fed keeps injecting money, but our economy isn't growing, then this is definitely an equation for disaster, because money's going out, but there's no way money's coming in. And just like a company, this can only last for so long. Just like a company, you can't sustain a country forever when you're spending more money than you are taking in. And in America's case, they've already been doing that for a long time. In this case, it's just been exponentially increased with the reduction in their GDP and their increase in their stimuluses and money they've been injecting into the economy. Therefore, we could kind of deduce that the economy, at least the United States economy, isn't doing so hot. So this leads to another question. The economy's not doing great. Who cares? A lot of people still there have their jobs. They're not going to be losing their jobs, because whether they work for companies that are doing great in these times or they're essential workers or whatnot, who knows? So should people like this put money into the market? The economy isn't doing great, but the market is, supposedly. So should these people take this time to put some money into the market? Who knows? I can't tell the future. This may be a great idea. The markets may just keep going up. But let's look at a few risks you guys should take into account before you put any money into the stock market. So the most apparent risk, and the most obvious one, obvious and apparent is the same anyways, is the resurgence of COVID-19. Again, the situation is kind of unprecedented. We've never had really a pandemic like this before in somewhat current times, but using something like the Spanish flu of the 1900s as a proxy, in the fall, the flu came back and killed more people than it did in the first wave. So if we take that situation and see it as a possibility of happening today, then we have the risk that in the next couple of months, COVID will come back with a vengeance, and there'll be an influx and exponential increase in cases. What will happen if that happens? Economies will close down again. We'll go back into quarantine. In theory, we actually don't know what governments across the world will do, but in theory, that's what their precautions, or that's what their the measures they will take. So if we go back into quarantine, then economies will slow down again. There'll be less consumption, affecting economies as a whole, and this will definitely have a negative impact on the markets. And who knows, we may see an even bigger and steeper dip than we did the first time during March. Second potential risk is the Fed halting intervention. Over the last couple months, the Fed has injected a ridiculous amount of money into the markets, hoping to increase liquidity. Even though this worked as kind of a band-aid to the problem in the markets and the economy as a whole, it was not a cure. If you inject money into an economy that's struggling and that has slowed down because of something like a pandemic, no matter how much money you inject into it, it isn't gonna speed up the economy or make it work any more efficiently. Even though the Fed's injection of capital into the markets has temporarily kind of fixed capital markets and the stock market, it isn't an end-all be-all resolution. And also another issue is the Fed can't just keep doing it. No matter what Jerome Powell says, they can't keep doing it forever. There is going to be a time where they're going to stop this the injections they've been doing, and liquidity is going to be reduced dramatically. I realize I've been saying the term liquidity a lot. What I mean by this, or by liquidity, is essentially giving people money to use. So that's the second risk. The Fed stopping any intervention in the capital markets. And the third potential risk, again, there's probably a lot of other risks, but these are some that I see in the near future and with the largest impact on the markets. And the third one is the obvious: elections. Both Trump and Biden seem to be using the economy as one of the pillars of their campaigns because they're trying to win the votes of a lot of these blue collar workers. So you're gonna see definitely, I guess, good things coming out of both camps in terms of strategies for helping the economy. But regardless of who wins, it's definitely gonna have an impact on the markets. So that's something you gotta watch out for as well. In my opinion, and this is the obvious opinion, is for there to be true economic recovery, we need a vaccine for COVID, or at least a solution for COVID. Because no matter what we do, how much money we inject, how much we reduce COVID-19 guidelines, a business is not going to function at its full potential till we get a vaccine. Just to give you guys an example of this is, no matter how much we do, restaurants are never going to do as well as they did before because people are just too scared, or at least most people are just too scared to go eat at a restaurant. They rather take takeout or cook just because they don't want to have the risk of sitting at a restaurant and getting COVID. So that's just one of the examples I have. But to reiterate, till there's a vaccine, I don't foresee any true economic recovery. Actually, let's rephrase that a little bit. I do see economic recovery happening, but not complete economic recovery. I don't see our economy working at the same levels as pre-COVID till there's a vaccine, obviously. So I rambled on a little bit too much in this video. So let me quickly conclude. Should you put money into the market right now? Sure, you definitely can. In my opinion, there's always quality stocks to invest in. I think the key thing to do right now is to find quality stocks that were impacted by COVID-19 and haven't fully recovered. These are the type of stocks that have definite upside in the short to long term that haven't been really acknowledged yet. Also, when you're looking for stocks, it's important to see what level of influence COVID-19 can have on them. So you wouldn't want to go buy something like an airline stock right now per se, just because if there is a second wave of COVID, those stocks will plummet once again. So if you want to put money in the stock market right now and you're not risky and you're trying to just build a long-term portfolio, find some quality stocks that have been impacted by COVID-19 and haven't fully recovered yet. That would be my kind of little 2 cents. Again, it's not investment advice. It's just my opinion for people trying not to lose money, but trying to make a little bit of money at the same time. Also, another thing is you can trade the market. I've made a couple of videos on day trading before, and the key thing about day trading is day traders make money when there's big swings in the market, and right now there's more swings than ever. So if you want to trade this market, you definitely can. Whether you're a long-term investor or a day trader or a swing trader, whatever you are, what I would recommend for you to do now is to be cognizant and aware that there's numerous risks in the market right now. So you could easily, I feel like more than ever, lose money. So you need to make sure you're putting money into the market that you do not need. Some money you need for daily expenses and to live. This is money that you're willing to lose. That's the type of money you should be putting into the market. That's probably the one piece of advice I would give to anyone right now. Again, to conclude, this is all just my advice. I'm just some random guy on the internet. You can take my advice, you don't have to. That being said, I think I'm done for this video. I rambled a little bit too much in this video, but I think I gave a couple important tidbits of information. So if you found this video useful, leave a like. And if you want to see more videos about the stock market, about investing, I'm gonna be making a couple of videos about real estate, a couple of videos about starting your own business. I'll be making videos all over the place. So if you're intrigued by that type of content, subscribe. I'll see you in the next one. Bye guys.